So looking ahead to the week in markets starting January 13th, it's our first week ahead video for 2020. So thank you again for tuning in. It's probably a good thing that I didn't attempt a week ahead video last week because it would have abysmally failed. No one could have predicted that the US and Iran would suddenly engage in massive geopolitical tensions, missile strikes going on left and right, and causing all sorts of turmoil in markets, only for markets to eventually close the week at record highs. I will discuss geopolitics a bit in this video, but we'll also talk about US earnings season, which starts this coming week, as well as of course, the signing of the US-China trade deal. Now, if we do look at what happened in markets last week, have to, of course, mention the fact that we finished the week at record highs. Apple shares at record highs, driving the Dow Jones, but also the S&P 500. Also the Euro Stoxx 600, so the biggest 600 stocks in Europe, also at record highs. The MSCI World Index, so an index covering shares from around the world, also at record highs. Australia's ASX index, also record highs. So you're getting the theme here that stock markets are generally doing pretty well. Didn't look like it would be the case at the start of the week. We had that massive sell-off, but obviously that proved to be a dip to buy into. In terms of the currency markets, the dollar has gained a lot of strength. I think that was in some anticipation ahead of the non-farm payrolls, and as well, it was a lot of volatility around this US-Iran situation. Sometimes the dollar acts as a haven, but obviously when the US was directly involved and at risk of going to war, actually the dollar saw some weakness, only to greatly rebound at the end of the week, in part due to some things that are happening around the world and other currencies too. Not least of which was the British pound, which actually had a generally fairly upbeat week, but was just slapped down towards the end of the week by the outgoing Governor Mark Carney, when he basically opened up the possibility of another rate cut and more quantitative easing in the UK, even when we're at record low levels of interest rates. So with all that said, let's have a look at the economic calendar for the week. CPI, very much the theme throughout the week. So inflation, of course, from consumers in the US, the UK and Germany will all be important ones to watch. General theme is that inflation remains incredibly low, and in most of these developed countries, wages are growing at a faster pace. Hence, consumers are able to keep the economy going, and this is the balance that central banks are trying to strike. Keep the consumer going with putting more money in their pockets via higher wages than inflation, but of course trying to meet their inflation targets as well. And so, hence, we're seeing a bit of back and forth on what central banks are saying. On that very front, we do have the first set of accounts from that first meeting, ECB meeting by the new head of the ECB, Christine Lagarde. And right at the front, at the end of the week, probably the big one to watch out for in terms of economic data is China Q4 GDP. So we've been told that January 15th is the likely day in which the US and China will sign off on a trade deal. So the Vice Premier out of China is making his way to Washington next week in order to meet up with US officials and sign off on this phase one deal. President Xi is not there. This is not everything done and dusted. There are still some sanctions that will remain on China. And so obviously the main man is not coming over to sign this part one deal. It's not clear yet whether Donald Trump will be involved in the signing of this phase one deal, but still from a market's perspective, obviously this is seen to be a success. A lot of the moves we've seen higher in recent weeks were in the preparation of this deal getting signed. So there's a risk actually that we get a bit of a sell the news event because this is so priced in at this stage. One market where I think it could add a bit of positivity is oil, which has been very downbeat amid all these geopolitical tensions. We had a spike up, and then when we saw inventories move higher again in the US, indicating higher supply, oil prices came right back down again. So potentially oil to want to look out for on this signing day on the 15th. But it's a big signature move in markets. We've been waiting for it for a long time. Once it's over, we can obviously look to other things like earnings, and economic growth around the world and what the prospects for those are. obviously with in mind the fact that things haven't escalated between the US and China, but tariffs are still in place and that potentially hurts global trade. It might just lift up business confidence enough to encourage a bit more investment around the world. And that's what people are looking for to sustain these high stock market prices. So the other thing to look out for this week is earnings, of course, and I do have a few statistics from FactSet that I'm going to quote to you, which I typically try to do, just in relation to the S&P 500 and what expectations are for that, for those top 500 companies in the US. So for Q4 2019, the expected earnings growth for the S&P 500 is minus 1.5%. If that's actually what happens, that will be the first time that we see 4 straight year-over-year earnings declines since Q3 2015. So obviously it's very interesting, and this is getting a lot of discussion, and you may be sitting back and thinking about it yourselves. Why are we seeing record highs in stock markets at a time when we're on the cusp of 4 straight earnings declines in the S&P 500? The two don't seem to be entirely correlated. I think one theory that makes sense to me is that actually stock markets are forward discounting mechanism. They're pricing in all the information ahead of time. So actually what we're seeing is stock markets pricing in an earnings recovery after this sluggish period that we're going through at the moment. So much like stock markets shot higher in the wake of Donald Trump's election, and then tailed off a bit when the tax cuts came through, because the initial move was pricing in the tax cuts, and then obviously the smart money's taking their money once it actually happens. And it's sort of a similar thing, I think, happening at the moment in terms of earnings. We're at the stage of stock markets pricing in a big recovery. Once that recovery actually starts to materialize, that could be a period in which the stock market treads water for a while or starts heading sideways, unlike the big uptrend that we're seeing at the moment. Other things to note is that in terms of earnings revisions, the expected earnings growth rate for Q4 2009 was 2.5%. So that was in September. So obviously all of those have lower rates today. It was plus 2.5% in September. Now it's minus 1.5%. So obviously estimates have been cut. That's tends to what you see ahead of time. So obviously it increases the chance that actually we see beats of estimates, and ultimately what we could see is that that we actually see a positive earnings surprise in the end instead of that decline in earnings that's generally being forecast here. A quick note, FactSet mentioned the valuations here, and I did want to mention that too. The 12-month PE ratio for the S&P 500 is 18.3. That PE ratio is above the 5-year average of 16.7. So as a rough estimate of things, the stock market is overvalued, but obviously we're in an uptrend and it can stay overvalued for a fairly sustained period of time until expectations change. Last but not least, I just want to touch on those geopolitics. So specifically between the US and Iran, I think there's probably 2 truths here, and this is something I said on a note the other day through email, is that the tensions between the US and Iran are unlikely to be over after these incidents. In fact, it's probably going to get much worse before it gets better. Things could have been much worse, and that's what stock markets are pricing in at the moment, that of all the potential scenarios out there, we've probably got the best one where there wasn't actually any direct military conflict. But the US has promised to impose more sanctions on Iran. It looks like there's an increased risk that some of the other partners in the Iran nuclear deal pull out. So all this is further economic pressure on Iran. And so they're unlikely to respond positively, at least in the short term. So that means more tensions. The hope is that in the long term, they come hat in hand to the negotiating table and a new nuclear deal can be worked out, paving the way for better relations with the region. But of course, much more adverse scenarios could take place. And so I think this is a risk we have to look out for the foreseeable future. It's going to be a 220 theme, I think. But markets have heard what they needed to hear for now. It turned out to be a blip on the radar in terms of the overall performance for stock markets. And so it doesn't look like we're going to get that much escalation. A couple of tweets from Donald Trump overnight in reaction to the missile strikes against the US bases, basically indicating no US lives were lost, and so there was no need for the US to take it any further. That was all, from a stock market perspective at least, that we needed to see. And so geopolitics put to the side for the time being, but it's a reminder to everyone that it's something that can play a big role in markets. And it's why I remain positive on gold. Gold had a massive run up during these tensions, hit that $1,600 per ounce, but it's since collapsed back down again. We might have a little period of weakness here as the geopolitics is taken out of the price, but I think in the background of all this, it's just a reminder that it's not a bad thing. It's just common sense to have some sort of portfolio hedge, and gold is one of the best ones out there. And so I think that underpins gold for the rest of the year. Right, that's it. Thank you very much for watching this video. And if you do enjoy them, of course, follow myself and LCG on YouTube and social media.